Hey Sonia, so as interest rates are rising, what's a good investment plan for me?
Okay, so one good option in a rising interest rate environment is investing in target maturity debt funds. Now, these are open-ended passive debt funds with a clear maturity date. So, these funds mirror indices made up of bonds that mature at a certain specific timeline. Now, as the interest rates have risen, target maturity debt funds are a good investment option because the yield offered by these funds looks relatively attractive, making their investment case stronger. Here are the benefits. One, it's a low credit risk fund. So, the funds predominantly invest in high-rated instruments like government securities, AAA-rated securities and PSU bonds. It's an open-ended fund, means you can enter and exit the fund at your discretion. There's no lock-in period. Then it's quite predictable and it has relatively high returns compared to an FD. So when the fund is held to maturity, the returns are expected to be similar to the net yield to maturity from the invested point. There are some funds like the Bharat Bond ETF where the yields are actually in the range of 7.6 to 7.75%. It's also quite low in tax. So when invested for a period of more than 3 years, indexation kicks in, making the taxation far more efficient. If we consider an inflation rate of 4%, then the effective tax comes to just about 11.5%. And finally, it's low in cost. So when you combine debt and passive, you know the costs are bound to be low, and this shows in most category funds having their direct expense ratio as low as 0.15 to 0.2%.